The dollar has been the world's reserve currency for so long. The assumption in America is everybody needs the dollar. They will keep on buying the dollar. They must keep on buying the dollar because they need it for trade. They need it to go and buy commodities, whatever. But actually, if you look at what's happening, the world is moving away from the dollar, and the people in America are the last to understand this. And I have to say that whenever you get a currency crisis, it is always the foreigners first who actually understand what's going on, because they don't need to hold a foreign currency. They will be the first to sell it. And then, at some later stage, the domestic users of the currency begin to realize that it's the currency going down, not prices rising. And that brings me on to another element of this, and that is inflation. The idea of inflation, as put about by the establishment and by the press, is rising prices which can be controlled. I mean, the latest one is, Ms. Harris saying that, price gouging and all the rest of it, and we will stop it. So we'll do what Diocletian did. Not that she's ever heard of Diocletian, I'm sure. And that is, put price controls on. It doesn't work. It never works. But the point about this is that the driver of inflation is actually budget deficit and consumer borrowing, to fund consumption. Those are the things that drive up prices, or, if you like, put the other way around and more accurately, drive down the purchasing power of the currency. And that is exactly the situation we still have, and it's going to get worse, particularly from the government end. And when you look at consumer behavior, savings in America have collapsed. They've gone negative. So, this is a disaster for the economy, where you have got a combination of a debt problem. You have got, a nasty recession, potentially a nasty recession, and I would actually call it a slump in the early stages of development. And on top of that, rising prices or a loss of purchasing power in the currency. This is the worst possible stagflationary scenario. Now, we had this back in 1976. And in 1975, actually, sterling collapsed against the dollar. It went down to around about, I think, $1.10, roughly where it got to in recent history, maybe even a bit lower than that. America came in and loaned us money in order to save the currency, which was fine. But obviously the condition was that the IMF come in, the IMF repays America, the IMF puts in controls, requirements, and all the rest of it, which takes it away from the politicians. And this is exactly what happened. The IMF said, right, you've got to balance your budget. Don't care. You raise your taxes, however you do it, but you've got to have a balanced budget. And in order to fund the situation, interest rates rose to the point where we had 3 bond issues of 15, 15.25, and 15.5%. Now, the problem that America faces is that there isn't someone like the IMF to come along and rescue them. I mean, it's just not there, because apart from anything else, you own the IMF. I mean, figuratively speaking, the IMF might account in SDRs, but basically it's a dollar-based organization, and it's not in a position to rescue the dollar. So you've got you have a situation which is worse than we had potentially in 1976. When we were funding at 15.5% coupons. Just imagine what that does to the US economy.
The dollar has long been regarded as the world's reserve currency, a status that has shaped the global economy for decades. Many Americans, both in government and on Wall Street, have operated under the assumption that the dollar's dominance is unassailable, that everyone will continue buying dollars because they need them for trade and commodities. But here's the uncomfortable truth. The world is quietly but steadily moving away from the dollar. This shift is seismic, and yet the average person in the US remains largely unaware of it. The reason for this disconnect, as Alasdair Macleod often emphasizes, is that when a currency crisis begins, it is foreigners, not domestic users, who first recognize what's happening. They are the first to dump a foreign currency because they aren't tied to it in the same way domestic holders are. Foreigners don't need to hold the dollar, and when they sense trouble, they are quick to sell it off. By the time the average American realizes that it's not prices rising, but the dollar's value plummeting, much of the damage will have already been done. Countries like China and Russia, as well as rising powers like India and Brazil, have taken concrete steps to move away from the dollar by trading in their local currencies and increasing their gold reserves. One of the most telling examples is the BRICS coalition, which is actively working on new trade settlements that bypass the US dollar altogether. But this shift doesn't happen overnight. It's a long, strategic process designed to minimize dependence on the US and its currency hegemony. The alarming truth is that the majority of Americans don't understand this global move away from the dollar. And by the time it becomes obvious, the damage will have already been done. As Alasdair Macleod mentioned, when a currency crisis happens, it's the foreign holders who first realize the risks and begin selling off their dollar assets. Domestic users, comfortable in their reliance on the dollar, are often slow to react until it's too late. Let's talk about inflation, one of the most misunderstood concepts in economics. Inflation is often framed by the media and government as simply rising prices. Politicians, eager to avoid responsibility, blame corporate greed, supply chain disruptions, or foreign conflicts. Take, for example, Vice President Kamala Harris's recent remarks about price gouging being the cause of inflation. It's an easy scapegoat, but it's far from the truth. The government's budget deficits and rampant consumer borrowing are at the root of the inflationary pressures we're facing. When the government spends more than it earns, it borrows. And when consumers take on more debt than they can manage to fund their lifestyles, the currency begins to lose its value. This isn't just an American problem, it's a global one. But since the US dollar is the world's reserve currency, the ripple effects are felt everywhere. As Alasdair Macleod points out, we're headed toward a stagflationary scenario, a dreaded combination of economic stagnation and rising inflation. The last time the US faced stagflation was during the 1970s, and it was a decade of economic turmoil, skyrocketing prices, and a stagnant job market. But what makes today's situation even worse is that US debt levels are at an all-time high, and savings have all but disappeared. The collapse of savings in the US is a significant red flag. When people aren't saving money, they're more vulnerable to economic downturns. In fact, the savings rate in America has gone negative, which means people are spending more than they earn, and they're doing it on credit. As a result, the economy is increasingly propped up by debt. Once this house of cards starts to fall, it won't be pretty.
The level of US government debt is roughly 130% of GDP. Now, to put that in context, it has been climbing to that level in peacetime. If you look at World War II, the most it ever got up to was 119%. In other words, the debt today is greater than it was with the war economy in 1946. Now, that is extremely important. The reason it's a debt trap occurs when the growth in your income, and it doesn't matter whether it's a government or individuals or a company, when the growth of income is less than the growth of debt. And obviously, the growth of debt includes the interest which is being rolled up. Now, that is now the situation again. We had this during the great financial crisis, when Lehman went bust. We had it in COVID, obviously. And we were just sort of getting our heads above water, or at least America was getting its head above water in terms of the debt trap, before we then started going down into that situation where income was not exceeding, if you like, the growth in debt. The growth in income was not exceeding the growth in debt. So, and the reason for that basically is you've got a slowdown in the US economy. You've also got inflation. And one way and another, the foreigners aren't really buying your debt. I mean, we've got China is not buying for her reasons, and nor is Japan. So the foreign involvement in acquiring debt, while since, I suppose, the Lehman crisis, their holdings in US treasuries have doubled. In fact, the percentage of publicly held debt in foreign ownership has actually fallen from just under 50% to just under 30%. So they're just not participating in the growth of your debt. We're now talking about a situation where foreigners are going to get less, if you like, in return for lending money to the US government because interest rates will be lowered. And this was clearly signaled at Jackson Hole by Jay Powell. And I think that is a huge mistake. And already we can see the effect on the dollar. The dollar has entered on a chart, something called the death cross, where the price is below the 55-day moving average, and the 55-day moving average is crossed below the 250-day moving average. All these, the price and average is all declining. That is a death cross. It's a very, very bearish signal. And you can understand why. And the other side of it, of course, is gold. And this is why gold is going so well. I mean, under the gold price, you have a golden cross, which is the reverse of the death cross. So, you sell dollars, buy gold. I mean, it's actually as simple as that. But returning to the debt problem, this means that the debt is going to grow to the point where it just basically becomes impossible to fund. And the only way in which it can be funded is for interest rates to rise substantially, and at the same time for the government to cut its spending and to ensure that its budget is in balance. Now, here we are ahead of a presidential election, in the presidential election year, and there's absolutely no hope of that. That is for sure. There's probably very little hope of it if what the two main contenders say about their policies come about. There's absolutely no hope of this happening in the next year or two.
As Macleod rightly points out, inflation isn't just about rising prices. It's about the devaluation of currency. The root cause of inflation lies in government budget deficits and consumer borrowing to fund consumption. When a government spends beyond its means and consumers take on too much debt, the value of the currency declines. Rising prices are merely a symptom of this underlying issue. And the situation in the US is dire. Savings have collapsed, even turning negative in some cases. What this means is that people are not only failing to save money, they are actively borrowing to maintain their standard of living. This combination of rising debt and a slowing economy is a recipe for disaster. When you throw inflation into the mix, you create the perfect storm of stagflation, a stagnant economy with rising inflation. This is not merely a theoretical danger. It's the reality we face today. Those old enough to remember the 1970s will recall a similar scenario. In 1976, the British pound collapsed against the dollar, forcing the UK to borrow money from the US to stabilize its currency. But here's the key difference between then and now. Back in the 70s, the International Monetary Fund, IMF, could step in to bail out countries in crisis. The IMF required the UK to balance its budget, raise taxes, and impose fiscal discipline. But today, who will bail out the US if the dollar collapses? The IMF, a dollar-based organization, cannot come to the rescue of the dollar. There is no higher authority to stabilize the world's reserve currency. At the heart of America's economic woes is an ever-growing debt burden. The US government debt currently sits at roughly 130% of GDP. For context, during World War II, when the US was funding an all-out global conflict, the debt peaked at 119% of GDP. Today, without the pressures of a world war, the debt is even higher. This is what economists call a debt trap. A debt trap occurs when the growth of income is less than the growth of debt. In simple terms, the government is borrowing more money than it can realistically pay back. And the debt isn't just about the principal. It includes the interest that must be paid on that borrowed money. As the debt grows, so does the interest, creating a vicious cycle where more and more borrowing is needed just to cover the interest payments. This problem isn't new. We saw it during the 2008 financial crisis, again during the COVID-19 pandemic, and now we are seeing it again. Despite brief moments of economic recovery, the US has continually found itself back in this debt trap. And here's where it gets worse. Foreign countries, once reliable buyers of US debt, are no longer interested. China and Japan, historically two of the largest holders of US Treasury bonds, have significantly reduced their purchases. The percentage of US public debt held by foreigners has dropped from just under 50% to around 30%. The message is clear. Foreign investors are losing faith in the US government's ability to manage its debt. Technically speaking, the dollar is in trouble. On financial charts, the dollar has entered what's known as a death cross. This occurs when the 55-day moving average of a stock or currency crosses below its 250-day moving average. It's a highly bearish signal that suggests further declines in the dollar's value. At the same time, gold has experienced a golden cross, where its short-term moving average crosses above its long-term moving average. A bullish signal that suggests higher gold prices are on the horizon. In simple terms, sell dollars, buy gold. Gold has always been a safe haven in times of economic uncertainty. It's not just a hedge against inflation, it's a hedge against the collapse of fiat currencies. When central banks lose control of their monetary policies, as we are seeing today, gold becomes the go-to asset for preserving wealth. The U.S. government's debt situation is unsustainable. The only way to fund the growing debt is to raise interest rates. But higher interest rates make it more expensive for the government to service its debt, pushing it even deeper into the debt trap. It's a classic catch-22. Raise rates to control inflation and stabilize the currency, or keep rates low and allow inflation to run rampant. And with the 2024 presidential election fast approaching, the chances of any politician taking meaningful action to tackle the debt are slim to none. Raising taxes and cutting government spending, the two most effective ways to balance the budget, are politically unpopular. Yet without these measures, the U.S. will continue hurtling toward economic disaster. In this uncertain economic landscape, gold and silver offer a way to preserve your wealth. They are not just investments, they are a form of savings. Unlike fiat currencies, which lose value over time, gold and silver have maintained their purchasing power for thousands of years. In fact, during times of crisis, the value of these precious metals often increases as people flock to them for safety. Let's not forget that gold isn't subject to the whims of central banks. It can't be printed at will, unlike fiat currencies, which can be devalued through reckless monetary policy. This is why central banks themselves are buying gold at record levels. They understand the importance of holding tangible assets in a world where fiat currencies are losing value. In the end, the decision to invest in gold and silver is about protecting your financial future. If you hold all your wealth in dollars or other fiat currencies, you are putting your purchasing power at the mercy of central banks and governments that have shown time and time again that they are willing to devalue their currencies to solve short-term problems. So the choice is clear. Hold on to fiat currencies that are losing value by the day, or invest in gold and silver, the only forms of money that have stood the test of time. It's not just about getting rich, it's about preserving what you already have. As the famous saying goes, those who fail to learn from history are doomed to repeat it. Don't be one of the many who wake up one day and realize that their hard-earned savings have evaporated due to the collapse of the dollar. Take action now, while you still can, to protect your wealth with gold and silver. After all, the future may belong to those who are prepared for the inevitable.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.